Hey guys, I can read what's in the wind. Let's talk earnings season then. Let's also welcome into the program on that front, Ben Brun. He is joining us live from the Australian Stock Report. Ben, nice to see you again.
Hi Nadine.
Live in our Sydney CBD studio. So give us your 2 cents on this 6,300 level and beyond. Doesn't look like we'll end at those decade highs as this match out continues for the 200, but you know, not too shabby considering.
Not too shabby indeed. It'll be an intriguing closing match just to see, well, A, if we can close above 6,300 and B, if we can post a new decade-long close to the good, obviously. But, I mean, every time we've traded above 6,300 points in recent memory, 24 hours later, you've lost your shirt. And, you know, sometimes you've lost your shirt and your jacket only 24 hours later. So it's going to be fascinating to see what sort of cue-in we get from Wall Street tonight, because despite all this, you know, everyone's waxing lyrical about China and being, well, almost cock-a-hoop with the potential for the PBOC and the authorities, I should say, to maybe step in to even the share market there. It didn't really reverberate in the sector of the market that you would usually suspect, and that is the materials sector. I mean, Rio Tinto had an off day today. BHP was okay. Fortescue a little bit down. It really was the banks. So I don't think we can understand how important, underestimate how important yesterday was, with CBA's earnings number up 2% yesterday, but followed that on nicely today, and Magellan, of course, today. So there is some earnings driving us, that's for sure. But, you know, this whole Chinese phenomenon, it's been intriguing over the last few weeks because it's been in a nosedive. And, you know, that's the epitome of a market that's taking everything with a glass half full mentality, because we've been watching the US market, which has gone from strength to strength while China's gone, you know, bitterly sour over the last few weeks. Now China has decided to sort of stem the tide a little bit, and we've taken that as good news. It'll be fascinating to see what Wall Street actually does tonight. As I said, futures market's not giving us too much by way of hints at this stage, but it's great to see. I'd like to see us at least stay above 6,300 in the closing match, and I'd really like to see us go on with the job tomorrow before we start talking about clear air. And just a little caveat, that puts the industrial space ex financials at about 30% above its historical average. So you can see why we've retreated so many times from that 6,300 point level.
Well, I think we might remain there today, 6304.4 at this very moment. And I think for the US season, would you say, Tony, as well, oil prices stabilized, and that was obviously such a jag through the overnight period.
It was, although we recovered from that as well. A lot of the major oil guys were down quite a bit more earlier on today, finished a lot of them to almost square positions. Just on the China side of things, there's a couple of glasses on the table and they're at different levels of fullness. Okay, let's open up the Chinese market, but boy, this is an equity market that's well and truly got whacked over more recent times. That's a glass half empty, I would still argue at this point. But a lot of the commodity prices over there have had a pretty good time of it of late. We've got iron ore prices and talk the Chinese fine prices back around 70 bucks, and that's a reflection of people expecting any softness coming through from China from trade-related tensions will be offset at least to some extent by infrastructure, and that's been flowing through as well to steel prices.
Yeah, all right. I don't think we'll crack that China nut in its entirety right now, because I would like to talk about Magellan, for example. Guy Carson, I mean, that was a pretty positive result on all fronts, and shareholders getting a sweetened dividend as well. So what does this tell us, I suppose, about some of those questions we were talking about 3 months ago about this whole funds management business in Australia?
Yeah, it's interesting. There's a lot of fears out there around the funds management space, because Magellan has carved out a great niche for themselves, and you go back sort of 10, 15 years ago, it was Platinum was the only game in town in terms of international equities. Magellan came up. Now there's more competitors, there's more choice. So the flows have been slowing, but and that's a problem for them, but they've got through that. They've got through it because they've had positive market moves, offsetting some distraction in terms of flows over the last year. So they're getting through it, but it's a more mature business. And I think they're right to actually increase the payout ratio, because it's a low capital business and they've got $500 million of assets on their balance sheet. They don't need to retain the capital, just get it back out to shareholders. So I think it's a good move to do that, and it's obviously the market likes it as well.
Yeah, no kidding.
Certainly in terms of the cash flows that they see, and they're just talking, we've got plenty for organic growth, so let's do the increased dividend. Interesting, Hamish has presented a challenge for himself. He's been talking negatively about the IT stocks in the US and the like, so it tend to indicate that they're just going to pull it back just a little bit in terms of the aggressive investment process. But as long as they still can deliver outperformance, there'll be a benchmark people measure that sector on.
Now, Ben, unless things have changed significantly with you since we last spoke, you're always keen to see what the brokers will be saying the next day. So when it comes to this Magellan result, I mean, what are the sort of analysts going to be weighing up going forward and moving forward for the company?
Well, that's the real thing. I mean, I know Hamish Douglas is 20% in cash at the moment. I guess the only criticism would be, why isn't he 100% exposed to this US market? It still seems to be going absolutely gangbusters at the moment, but that's a very small critique. I mean, the numbers were beautiful, weren't they? The boys on our trading desk were high-fiving. Just, you know, it was a very, very juicy result, and a lot of our clients are very long this stock. So obviously we're extremely happy, and we're extremely happy with the share market reaction as well. In terms of what the brokers do, now you've caught me a little bit on the hop because I don't know. I'm assuming they're going to be quite positive. So the only thing when you get a really positive stock, or brokers being very largely positive on the stock, there's no wiggle room to the upside. Sometimes, ironically, you can get some of the ones that are saying outperform and buy move into a more neutral rating because the share prices just run so far past their target. So you know, it's not an exact science, especially if they're all one way or the other way, and the result is going the way that they that all the brokers are saying. So, but gee whiz, I mean, you know, they return all the cash to shareholders, pretty much all the cash. The payout ratio 90 to 95%, but they don't need it. And Hamish Douglas just said, well, if we don't need it, you may as well take it. And the market absolutely loved the story. They loved the earnings, they loved the dividend. Yeah. It was terrific.
I guess the opposite end of the spectrum, and there are many more companies that we'll be speaking about throughout the hour. But before we let you go, Ben, AGL, I mean, that's the flip side of things, isn't it? Really missing the marks, but still maintaining its market share. I suppose doing so at the expense of margin. So again, when it comes to how we will read this result tomorrow, if there will be more selling tomorrow, what do you think the analysts will really be pointing to?
I think there will be. I'd be a lot more confident saying that the brokers will be negative on this one than I would be the brokers being positive on Magellan for the reasons I just went into. But look, you know, we thought the cat's in the bag here. On first blush, look at the 2018 result and the sweeter dividend, beat on both those metrics. But it was 2019, and how many times have we learned this lesson? It's about the outlook, you know, sometimes a lot more than, you know, the backwards-looking indicator, which is the 2018 result. So, and of course, it's a political football as well, these energy prices. So we don't really like that thematic. Anytime the government starts to meddle or get involved, it's just not an industry or a stock we want to be part of. So yeah, not surprised to see it down. And in fact, if it hadn't had so much pressure on it, exerted on it in recent times, I think it would have been down even further because it was about a 6% miss on consensus for 2019. So yeah, certainly not surprised to see it down. And I would suggest, if I'm going to stick my neck out, I'd say it's probably going to be down again tomorrow on some broker downgrades.
Okay, Ben, nice to see you again. Thanks for joining us.
And you, thank you.
I'll chat earnings.